This topic is about equity indexes, from learning module, security market indexes. Sector indexes allow you to separate or isolate these two different skills, so you can see exactly where the manager is adding value. Option A. While investors use these indexes to track trends, their primary role in performance evaluation is to analyze what has already happened, not to predict the next business cycle. Option C is incorrect because there is no universally agreed upon method for classifying sectors globally. Whenever you see an index defined by size plus value or size plus growth, it is always a style index. Style indexes are often used by investors to target specific styles of investing, such as a small cap growth investor or a large cap value investor. Style indexes typically have higher turnover than broad market indexes because companies frequently move between categories. For example, a stock might grow too large to be mid-cap, or its price might rise so much it is no longer a value stock. Whenever an index is defined by an industry, such as finance, technology, energy, it is a sector index. Model portfolio is the standard phrase for the blueprint an ETF uses to build its holdings. In index construction, the very first decision is always identifying the target market, and an economic sector is one of the most common ways to define that market. This topic is about fixed income indexes. In the bond market, illiquid means you can't always find a buyer or seller immediately, which makes it very hard to know the true market price at any given moment. Bonds are sold over the counter through dealers, not on the central stock exchange. This makes data harder to find. There are thousands more bonds than stocks, which is a challenge for index construction, not a limit on diversification. Think of an aggregate index as a pie. You can cut it into specialized slices known as sub-indexes based on credit quality, maturity, or the type of issuer. Broad market indexes are never exclusive to one type of bond. They specifically aim to include a variety of market sectors and credit ratings. The most important takeaway is that these big indexes provide the foundation or starting point from which specialized indexes are built. Primary dimensions are always things that move the needle for investors, like who issued the bond, when it matures, its credit rating, and what currency it uses. Coupon frequency or specific payment timing is not a dimension used to construct fixed income indexes. The difference between a category, like 10-year bonds, and a detail, like pays interest on March 10th, indexes are built on categories. Because there are so many securities and many of them are hard to find or buy or illiquid, it is much more costly and difficult for an investor to perfectly copy a bond index than a stock index. Stocks have a central scoreboard, an exchange, but bonds are sold over the counter by dealers. This makes getting data for an index a constant challenge. Broad bond indexes often have to include thousands of securities just to represent a single segment of the market. Always remember the big three challenges of bond indexes: massive number of securities, lack of liquidity, and lack of transparent pricing. Don't confuse how an index performs with how hard it is to copy it. Even if a bond index has steady returns, the physical act of buying every bond in that index is a massive logistical hurdle. Always remember that there are many more bonds than stocks. This massive number of securities is exactly what makes bond indexes so difficult and expensive to copy. In hedge fund indexes, the constituents, the funds, actually determine the index by choosing where to report rather than the provider choosing the funds. In the stock market, you use actual trade prices. In the bond market, you often have to use pricing estimates. Bonds trade on dealer market. The lack of central scoreboard or exchange is the root cause of the bond market's pricing challenges. Whenever you are asked why fixed income indexes are more difficult or costly to manage than stock indexes, the answer is almost always related to illiquidity and pricing data. This topic is about indexes for alternative investments. Be aware that a commodity index might go up even if the spot price of oil or gold stays the same, or vice versa, because of the roll yield. Option A. Indexes do not store commodities in warehouses because it is too difficult and expensive. They always use futures contracts. Option C is a distractor. Index providers create their own weighting methods, rather than just averaging producer prices. Option A. Commodity indexes do not hold physical inventories in warehouses, so they don't get capital appreciation on stored goods. Option C. Commodity indexes track prices, not the companies that produce them, so they do not incorporate dividend yields. Whenever you see a gap or divergence between a commodity index and the actual price of oil, gold, or corn, the answer is almost always the roll yield. If the index relies on an expert's judgment instead of a price tag from a real sale, it is an appraisal index. This is the most important link. Real estate is highly illiquid, meaning transactions are infrequent. This is exactly why appraisal indexes exist. They provide a guess at the value when there hasn't been a recent sale. REIT indexes provide continuous pricing, like stocks, while appraisal indexes only provide periodic updates when the estimates are made. Hedge fund indexes rely on voluntary cooperation. If a fund doesn't want to be in the index, it simply doesn't report its numbers. In equity indexes, Provider picks the members. In hedge fund indexes, the members effectively pick the index. Because reporting is voluntary, notice that these indexes often have survivorship bias. Funds that are doing poorly are less likely to volunteer their bad news to the database. Overstated means too high. Hedge fund indexes often suffer from survivorship bias, which makes the index look better than the actual experience of all hedge fund investors. Option C is incorrect because there is no central regulator that requires these funds to report their performance. Because the funds themselves decide whether to be in the index, the constituents determine the index rather than an independent provider choosing them based on objective rules. Whenever there is a divergence between what physical prices are doing and what the index is doing, the answer is almost always the raw yield. These indexes do not store items in warehouses, no physical goods, so they don't simply track the spot price. Because the index is a portfolio of futures contracts, it will never perfectly match the price of the physical commodity you see in the news.